Chapter 1: Why most people think insurance is a scam. Is insurance a scam? A lot of people think so. They hear stories of denied claims, fine print, and greedy salespeople. They watch friends pay thousands in premiums and get nothing back. They see social media posts about someone being saved to buy insurance. Then they hear another post say they were cheated. It's confusing and frustrating. But the deeper problem isn't insurance itself. It's how most people buy it. Let's look at why so. Many end up angry or regretful. A large group buys insurance because a friend or cousin started selling it. They never read the contract. They just want to help someone out. They sign quickly, not knowing what's covered or what's excluded. Years later, something happens. They file a claim. It's denied. And they feel betrayed not just by the company, but by the friend too. Another group buys cheap plans they find online. Low premiums, minimal coverage. Sounds like a deal. But when a real problem hits, the payout is too small to help. They think, what was the point? Then there's the fear-based buyers. They scroll through their feed. They see stories of illness, accidents, and emergencies. Each one ends with, "Thank God they had insurance." They panic. They buy coverage out of fear, not based on logic, not based on need, just fear. And what happens when nothing bad occurs? They feel like they wasted money. Or worse, when something does happen and the coverage doesn't apply, they feel scammed. All of this builds resentment. They start telling others insurance is useless. And the cycle repeats. Fear-based buying leads to poor choices. Emotion replaces logic. Pressure from agents replaces planning. And insurance turns into a regret. But is that really the insurance company's fault? Or is it the buyer's misunderstanding? The truth is simple. Most people buy the wrong kind of insurance for the wrong reasons. That's why they get burned. It's like when they don't work. You don't blame the tires. You just didn't need them in the first place. The passive path is all about smart decisions, not following the herd, not falling for pressure tactics, not letting emotion lead your money choices. Next, we'll break down what insurance actually is and why thinking like a gambler might be the smartest way to look at. Chapter 2: What insurance really is. A bet you hope to lose. Insurance is a bet. You pay money now, hoping you never need to collect. It's the opposite of a lottery ticket. With a lottery, you pay a little for the chance to win big. With insurance, you pay a little so that if something terrible happens, you don't lose everything. You're not trying to win. You're trying to avoid disaster. Imagine hiring a bodyguard. You don't want them to tackle anyone. You just want to feel safe walking around. Insurance works the same way. You pay for peace of mind, not for profit. This is where most people get confused. They think insurance is supposed to give something back, like a savings account or an investment. But insurance is neither. It's not meant to grow your money. It's meant to protect what you already have. There's a cost for that protection, and the cost is called a premium. That money goes to the insurance company. They pool it with premiums from millions of others. Most of those people will never need a payout. That's how the system works. It's a game of odds, a game of risk, and you're the one choosing which risks to offload. Let's say you're 35. You're healthy. You drive safely. You have no debt. You might think insurance is a waste. But one accident, one unexpected illness, one lawsuit, and your financial life could unravel. Insurance exists for that moment. The low probability, high impact event. The thing that doesn't happen often but hurts the most when it does. It could be a house fire. It could be a car crash. It could be a hospital stay that costs more than a year of income. You could try to save for those things, but it would take decades. And in the meantime, you'd be exposed. So you pay someone else to carry that risk. That's all insurance is. Risk transfer. You offload the worst case scenario to someone bigger, to someone who can absorb it. The more likely the event, the more expensive the coverage. The less likely the event, that's why life insurance for a healthy 25-year-old costs less than coffee. But disability insurance for a construction worker is expensive. The odds are just higher. This is why rich people don't skip insurance. Even though they can afford losses, they'd rather not take the hit. They understand this bet. They know the math. And they play the odds the smart way. What if you thought like that? What if you stopped thinking about what you to get back from your insurance and instead asked what it would cost to not have it? You'd make very different choices. Up next, the quiet truth about how wealthy people use insurance. Chapter 3. Why the rich never skip insurance. Rich people don't see insurance as optional. They see it as a shield. Not because they are scared, but because they have something worth protecting. When you have assets, you don't gamble with them. You lock them down. You defend them from chaos. That's why wealthy people buy insurance others ignore, like umbrella liability coverage, or key person insurance for their businesses, or disability insurance that pays even if they can't work for just a month. They know one lawsuit, one illness, one accident can cause a chain reaction, and they won't risk letting that happen. Imagine a professional athlete. They insure their legs, their arms, even their voice. Because if they lose that function, their income disappears. Now think about Elon Musk. He has layers of insurance most people have never heard of. He has coverage in case something happens to him and his board needs to be compensated. He signs deals where failure to perform means paying out of his own pocket. No one forced him to do that. It's smart business. He offloads risk so Tesla and SpaceX can keep moving even if he can't. Now let's bring it closer to home. Say you own a business. You're the main revenue generator. What happens if you get injured? What if you can't work for 6 months? Do the bills stop? Do your employees pause payroll? Of course not. Without insurance, your family or your business takes the hit. With it, there's a payout. Enough to keep things moving while you recover. That's what insurance is for. It keeps your engine running when life throws a wrench into the gears. The rich understand that time is money, and that chaos costs more than preparation. That's why they insure more than just cars and homes. They insure cash flow. They insure reputation. They insure continuity. Because when something goes wrong, they don't want to stop. They want to keep building, earning, investing. And stability is what allows wealth to grow. What would your life look like if chaos didn't scare you? If one emergency didn't erase everything? That's the power insurance gives. Up next, how to tell good insurance from bad and why most people. Chapter 4, Good vs. Bad insurance. Not all insurance is good insurance. Some policies protect you. Others just drain your wallet. The difference is in what they promise and what they deliver. Good insurance is simple. It pays out when something bad happens. It has clear terms. It covers serious risks. It doesn't pretend to be an investment. Bad insurance is complicated. It mixes protection with savings. It promises returns but hides the fees. It locks up your money for decades. And when you finally need it, you find out it's worth less than you thought. Let's start with what works. Term life insurance. It's cheap. It covers a fixed time 10, 20, or 30 years. If you die during that term, your family gets paid. If you don't, the coverage ends. No gimmicks, no tricks, just protection. Another smart option is critical illness insurance. This pays out if you're diagnosed with a serious condition, cancer, heart attack, stroke. It gives you a lump sum to handle treatment, recovery, or lost income. Then there's disability insurance. If you can't work, it pays a percentage of your income, month after month. That keeps your bills covered while you heal. These are the essentials. They handle the most expensive personal risks. They cost less than most people think. And they don't tie up your money. Now look at the opposite side. Savings-based insurance. Also called whole life or universal life. They sound appealing. They offer a death benefit and a cash value. You can borrow against it. You can let it grow over time. Some even say it's a retirement plan. But here's what they don't say. Most of your early payments go to commissions and fees. It takes years, sometimes decades, just to break even. If you cancel early, you lose money. And if you die early, the payout might not even match what you paid in. It's like combining a bank account, an investment fund, and a protection plan and doing all three badly. These policies, the commissions are high. That's why agents push them so hard. But the returns are slow, and the flexibility is low. They sell the dream of growing wealth, but they forget to mention inflation. The money you get back in 30 years might buy half of what it does today. That's not security. That's illusion. Good insurance transfers risk. Bad insurance tries to sell peace of mind and profit at the same time and fails at both. Here's a simple rule. If it sounds like an investment, it's probably not. Good insurance. If it sounds like protection, it might be worth a closer look. Protect first, grow later. That's how the passive path does it. Next, we'll break down how to know exactly how much in Chapter 5, how much insurance should you really buy? Forget the rules you've heard. Forget the 10% of income guideline. Forget the agent who said, just trust me. There's no magic number. There's only one real test. Can you afford the premium without stress? And does it cover a risk that could ruin you? If the answer to both is yes, then it's worth it. If not, skip it. Let's break it down. Start with your monthly budget. Look at your current expenses, rent or mortgage, utilities, food, transportation, savings. Then add the people who depend on you. Do you have kids, a partner, parents who rely on you? Now ask yourself one question. If something happened to you tomorrow, what would they need? How long would they need it? That's the number to insure. Not your full income. Not your entire lifestyle. Just the part that matters most in an emergency. Here's a quick formula. Add up 1 year of living costs. Multiply it by how many years you want your family protected. That's your ideal term life coverage. Now for critical illness. What would it cost to take 6 months off work? What if you needed treatment in another city? What if your income paused but your bills didn't? That's the number to insure. And for disability insurance, if your job is your only income, protect at least 60% of it. That's what most good policies offer. Enough to survive, enough to stay afloat, not to thrive but to hold the line. Now test your budget. Take those annual premiums. Divide them by 12. Can you pay that monthly and still live your life? Still eat well? Still enjoy your time? Then you're good. If it strains you, If it forces you to cut back on food or rent or joy, you're overinsured. Dial it back. Insurance is protection, not punishment. We're not here to suffer just to feel safe. You're here to live. And smart insurance makes that easier, not harder. Coming up next, the biggest mistakes people make when buying in Chapter 6. Common mistakes to avoid. Most insurance regrets come from the same mistakes. They are easy to make, but even easier to avoid. The first mistake is buying too early, too big. Someone gets a job, makes their first paycheck. An agent convinces them to buy a massive whole life policy. 30 years locked in. High premiums. No flexibility. They say it's an investment, but it isn't. It's a wait. And once you're in, getting out means losing money. The second mistake is buying too late. People wait until they are older or until they feel at risk. But by then, the price has gone up, or worse, their health has changed, and they are no longer eligible. Insurance works best when you buy it before you need it, before risk shows up. The third mistake is confusing insurance with savings. They hear about policies that build cash value. They are told they can borrow from it later, but no one mentions the fine print, or the slow growth, or the penalties for early withdrawal. It's not saving, that's being stuck. The fourth mistake is trusting without reading. Too many people buy policies they don't understand. They rely on trust. They assume good intentions. They skip the terms. And when something goes wrong, they are shocked. They say, "I thought it covered that," but it doesn't, because they never checked. The fifth mistake is not updating their coverage. Life changes. Marriage, kids, new job, new income, but the insurance stays the same. It no longer fits. It's either too much or not enough. That gap can cost you. Set a reminder every 3 to 5 years. Review what you have, what you need, and what's changed. The last mistake is relying on employer coverage. Yes, it's free or cheap. Yes, it's convenient. But if you leave the job, the coverage ends, or it shrinks, or it's not portable. Always have a plan that you own, that you control, that stays with you no matter where you work. Insurance is personal. The right policy at the wrong time is still the wrong move. Avoid these mistakes and you're already ahead. Next, we'll explore how the wealthy use insurance not just for emergencies but as a pillar of life. Chapter 7: Insurance as a Financial Defense Strategy. Insurance isn't just protection. It's strategy. It's the way smart people build walls around their wealth. They don't just earn, they defend. Because one bad event can wipe out years of effort. The rich know that, and they act accordingly. Think of insurance like a hedge, a backup plan built into your main plan. Companies do this all the time. They hedge against price swings. They lock in costs through contracts. They reduce risk by spreading it, and they insure what matters. You can do the same. Let's take a story from the food industry. In the 1980s, McDonald's wanted to launch chicken nuggets, but to offer a low price, they needed to guarantee a low cost for chicken. That meant locking in long-term prices with suppliers. Suppliers were worried. What if feed prices went up? What if costs spiked? They couldn't afford that risk. So McDonald's brought in Ray Dalio. He created a system using futures contracts. If feed prices rose, the contract paid the difference. If prices stayed low, the supplier lost a small fee but gained long-term stability. Everyone won. That's what insurance does. It trades small costs for big stability. It lets you move forward without fear. Now apply that to your life. Let's say you're starting a business. You've invested your savings. If you get sick, the business stalls. Insurance fills the gap. Let's say you're a freelancer. No paid leave. No sick days. Disability insurance becomes your safety net. Or you own a house. One fire, one lawsuit. Without coverage, you could lose everything. Insurance is your fireproof vault. It's what keeps the game going when things go sideways. The passive path isn't about hoping for the best. It's about preparing for the worst so you can focus on the best. Rich people don't skip steps. They cover their bases. They know that wealth isn't just about upside. It's about next. We'll break down the only 3 policies most people actually need and why they handle almost. Chapter 8. The 3 must-have policies. Most people don't need a dozen types of insurance. They just need the right 3. If you get these right, you're 80% covered. Everything else is optional. The first is term life insurance. This protects your family if you're no longer around. It's not about you. It's about the people who depend on you. It gives them time, breathing room, space to grieve without worrying about bills. Term life is simple. You pick a term 10, 20, 30 years. You pay a monthly premium. If you die during that time, your family gets paid. No savings, no tricks, just protection. Buy it when you're young and healthy. It's cheap, and buy enough to cover debts and future needs. The second is critical illness insurance. This pays a lump sum if you're diagnosed with something serious. Heart attack, cancer, stroke, the kind of events that flip your life upside down. The payout is yours. Spend it how you want. Treatment, travel, replacing income. No questions asked. This isn't health insurance. It's financial support when health fails. The third is accident or disability insurance. This pays you when you can't work. Injury on the job, surgery, chronic pain. If your income stops, this keeps the lights on. Even a short disability can wreck your savings. This coverage keeps you in the game. These 3 policies work together. 1 for death, 1 for serious illness, 1 for lost income. That's your core. That's your defense. And here is the good news. They don't have to be expensive, especially if you avoid savings-based policies. Stick to term. Stick to coverage-only plans. You'll get more protection for less cost. Ask for consumer insurance, not savings insurance, not investment-linked insurance. Just protection. That's what matters. These 3 policies aren't glamorous, but they are powerful. They are how you avoid financial collapse. They are how you protect your family. And they are how you next. We'll show you how insurance evolves as you build wealth and why the policies you need today. Chapter 9. How insurance fits into financial freedom. Insurance isn't a one-time decision. It changes with your life. As your income grows, as your responsibilities shift, as your goals evolve, your coverage should evolve too. In the early stage of wealth building, protection comes first. You don't have assets to fall back on. A single crisis can wipe out your progress. This is where basic insurance matters most. Term life to protect your family. Disability to protect your income. Critical illness to cover the unexpected. It's not about luxury. It's about survival. Then comes the growth stage. You're earning more, maybe starting a business, maybe investing. You now have more to lose. Insurance becomes a financial tool. You add liability coverage. You protect your assets. You think about umbrella policies. You use insurance to defend the wealth you're building. Later, in the legacy stage, the goals change again. It's not about protecting income. It's about protecting your estate, your retirement, your heirs. You may buy long-term care insurance, or policies that optimize taxes, or life insurance that covers estate costs. The goal is to preserve, not just protect, to make sure what you built isn't lost through fees, taxes, or delays. At this point, you might not need term life. Your kids are grown. Your debts are gone. But you might still carry policies for strategic reasons, not for fear, but for control, for leverage. Insurance follows your freedom. It starts as a safety net, then becomes a shield, then becomes a legacy tool. At each step, it supports your independence. That's the mindset behind the passive path. Design your insurance the same way you design your investments, with intention, with flexibility, and with a clear understanding of why you own it. Coming up, the final word on insurance, risk, and how to build a financial life that doesn't. Chapter 10, Final Thoughts. Insurance isn't about fear. It's about freedom. The freedom to keep going, the freedom to recover, the freedom to protect what you've built. It's not supposed to make you rich. It's supposed to stop you from becoming poor. If you never use it, that's a win. If you do use it, that's survival. Either way, you're better off. Insurance gives you margin. It gives you time. It gives you options when life throws a problem your way. Without it, you're exposed. One accident, one illness, one lawsuit, and your future changes forever. That's not drama. That's math. That's reality. You can spend years saving and investing, but without protection, it's all fragile. And fragility is the enemy of financial freedom. So buy what matters. Skip what doesn't. Understand what you own. Don't rely on agents. Don't follow trends. Don't expect profit from a product designed for protection. Keep it simple. Keep it clean. Cover your downside, and then go build your upside. That's how real wealth works. That's how financial independence is built. And that's the path we follow here. The passive path is about more than money. It's about choices. It's about control. And it's about building a life that lasts even when things don't go according to plan. Like, subscribe. Share this with someone who needs to hear it. Thanks for staying until the end. If this video helped you think differently about money and protection, take a second to like it. Subscribe so you don't miss future videos that help you build wealth and stay in control. Drop a comment with your thoughts or questions. I read them all. And share this video with someone you care about. Someone who might be one accident away from financial trouble. Wishing you clarity, confidence, and calm in your financial journey. Feel free to explore the other videos on this channel. Each one is designed to help you move one step closer to freedom. See you in the next video.